Hi, my name is Rebecca Chia, and it's a pleasure to be here today to do a Tide 10 interview with Eunice McHugh of San Francisco Employees Retirement System. Hi, Eunice. How's it going?
Hi, Rebecca. How are you? Thanks for having me.
It's a pleasure to be here with you. Before we kick off into the meat of the dialogue, I'd love to give just a quick introduction. Again, my name is Rebecca Chia, and I work with Atalaya Capital Management. We are a $6 billion private credit and special opportunities fund focused on financial assets, real estate, and corporate investment opportunities. We have a variety of strategies ranging from current income-focused investment strategies to those that also focus on total return. I'll also give a quick background on Eunice. Eunice is a senior portfolio manager at San Francisco Employees Retirement System, also known as SFERS, and she has been in the industry for nearly 15 years. Today, her role is focused on running the private credit allocation at SFERS, which is roughly 10% of the plan's assets. And she looks at a wide variety of different strategies within private credit, which we'll go into in a bit later. Previously, prior to joining the plan, she had worked at Morgan Stanley, as well as Lehman Brothers, and she has her bachelor's in economics from UC Davis. Eunice, thank you again for taking the time to join us, especially as I know you have a very busy schedule, in addition to work, but being also a working mom. I'd love to kick off, you've got a big job at San Francisco Employees. The plan itself is about $30 billion. Again, you manage roughly 10% of those assets. So I'd love to know, as a leader in the asset management space, how do you think about private credit? What's the use in the portfolio? What sorts of things do you look at within private credit? And what types of strategies interest you and why?
So San Francisco established an allocation to private credit really with one objective, and that was to achieve returns superior to what we would be achieving in public fixed income, specifically within our bank loan and high yield portfolio. So the return targets for our private credit program is to an 8 to 10 net IRR for the overall portfolio, but then we also look to achieve about 300 basis points above what we would achieve through liquid credit. Our portfolio covers everything from senior debt to mezz to distressed. We also have an opportunistic and real estate bucket, as well as a specialty finance bucket, which is where we place our asset-based lending opportunities, including a lot of the other niche strategies that throw off a lot of current income. Today, we are focused on three main areas. That would include one being Asia private credit, just given that the dry powder there is significantly lower than what you see in the US and in Europe. We're also focused on opportunistic strategies versus, dedicating to distressed managers, given that we'd like our managers to have flexibility in today's market, just given all the market uncertainty over the next 12 to 18 months. And the third area of focus for us is the specialty finance bucket, which is where, like I said, we've focused on asset-based lending, which, Atalaya is a leader in the space, along with a lot of the other credit-like strategies, including leaseback, royalties, life settlements, et cetera, that throw off a lot of cash.
So good. Looking back in your portfolio and, the past year and a half or so, obviously there was a very short-lived dislocation last spring. I'm curious to know, how did your private credit allocation hold up during that period? How did it perform? Was it in line with expectations? And then also, was there anything coming out of that dislocation that has shifted your view on sort of your capital allocation?
For the most part, the portfolio has performed well through COVID. And we did have some write-down, particularly within our leaseback portfolio, where we do have some aviation managers. The fortunate thing, though, for SFERS was that a lot of those commitments were recently made. So we still have a lot of unfunded commitments and dry powder in that space, which we think will hopefully benefit well, given the repricing of assets there. What surprised me the most, though, was we were excited about how the distress opportunity set and but ultimately how short-lived it was as a result of all the stimulus provided by the government. And that really has shifted my views on distress, right? I mean, there is no limitations to what the government can do. And as a result, I think that is something investors have to think about. We were not expecting for the Fed to purchase corporate bonds, and they certainly did. And that, like I said, just really made the distress opportunity set very short-lived and has certainly, like I said, influenced how we think about having an allocation to stress, or even also influence our thoughts on distressed managers. I think now we would prefer to see smaller fund sizes, or maybe there is some sort of activation fund or an A/B tranche, or by keeping the main fund small. But we also prefer opportunistic managers too, managers who can pivot in and out of opportunities.
Let's shift gears a little bit. You and I have talked about what it's like to be a working mom, to be in this industry where you're a minority and you're a woman. I'd love to hear from you as you look back on the past 15 years in this industry. How would you view the progress that's been made as it relates to diversity and inclusion?
That's another great question, Rebecca. I think the short answer is that there has been progress, but I wish there had been more progress over the past 15 years. I think the biggest change is that we are actually having conversations today around diversity and inclusion, whereas 15 years ago, those conversations were not being had. And 15 years ago, I don't think organizations were also looking at the diversity breakdown of their own employee base. Whereas today, I think that is something that organizations are starting to consider more about. I would say that, my hopes for the diversity inclusion efforts within this industry and within society as a whole is that I hope these conversations continue to occur and the momentum around these conversations continues to grow. And my bigger hope is that in 15 years, there will have been so much change that by the time our daughters are working mothers and working women in the industry, that it isn't even something we have to think about.
I agree. I love that idea. I guess along that note, what do you think are the most effective ways for us to help continue to promote the diversity and inclusion?
That's another good question. And I think for us, San Francisco as a limited partner and other limited partners, we have a lot of influence, right? We can put pressure on our managers to think about this more. For San Francisco, what we do in private credit as part of our diligence is we do ask for a diversity breakdown of an organization's employee base, right? Not only just the entire employee base, but also looking at the investment roles, right? Also looking at who's sitting on the investment committee, the management boards, right? And then also having conversations around compensation, right? Along with the distribution of carried interest, making sure that women are getting a fair portion or their fair portion, relative to their male peers. I think those are things that LPs can do to influence, or at least that can be a starting point in conversations with managers.
Yep, absolutely. I think those are wonderful ideas. And I think it's great to see that groups like yourselves are starting to implement those in your diligence. So thank you again, Eunice, for taking time out of your busy day to do this Tide 10 interview. It was certainly interesting and always great to get your insights. So thank you. And I hope everyone enjoyed this interview with Eunice McHugh of San Francisco Employees Retirement System.